Okay, good morning and welcome to the Minervini Private Access Training Room. I'm Bob Weissman. If you could do a quick hand raise to let me know that you're hearing me loud and clear. There's nothing being projected just yet. Mark will be joining in just one moment where you'll be seeing his charts, but that looks good. And also if we could welcome Mark Ritchie into the room. Good morning, Mark.
Good morning, everybody.
And if you could hand raise for him as well. You'll hear Mark has a little bit of a hoarse voice due to the fact that he did test positive with COVID a couple days ago. So he is still in the recovery mode, but a tripper to still join us today.
I'm here.
Okay. And now let's check with Mark Minervini. If you can hear Mark, if you could raise your hand.
Testing 1, 2. Hello, hello, hello.
And Mark, you need to project.
Yep, I'll project. And is Mark Ritchie here?
Yep.
He is. I'm here.
You do have a hoarse voice. How you feeling?
I'm doing all right. I'm doing all right.
Oh man.
Our first comments would be just to hope everybody safe in the New Orleans area with Hurricane Ida is doing well. And obviously, if you live there, you can't hear us since there's no power.
New Orleans can't catch a break, man. I'll tell you.
One after another every year, it seems like. But with that said, Mark is projecting now, so I see you, and we can get started with the questions, Mark. Pull them up here.
All right, let's see here. All right, you're going to start with questions, Bob?
Yeah, unless you had any initial comments you wanted to start off with.
No, just that this, like I said in the weekend, that this market is really quite nutty. I mean, it's in the fact that, in respect that it's just all over the place from day to day. And again, you just see stock after stock. One day it's looking good, next day it's not. And my only advice is just completely stay away from, letting the indexes lure you into any sense of, security or even a sense of danger, because, it's just so split and the indexes aren't really telling the truth with respects to maybe what you're doing with your own strategy. So just stick with the stocks. If the stocks are working, great. If not, try to shift your thematic, way you're playing thematically until you get something that works. And if it's too much volatility and you can't, get traction, you just got to sit it out and just wait. I assure you that this type of environment will be, to use the word of the day, transitory. So again, that would be my advice at this point. I've been just sticking to just, following the stocks and trading what's working, still short-term trading, financing my risk, not really, having any long-term horizon on these things unless I'm covered with some profits that I took, and then, setting my stops, even if my stops are larger than originally with the short-term trade, they're being financed. So I'd be at break even. And then if things aren't working out, if I buy something and it turns around on me real quick, I'm just out, I'm just getting out like immediately. Swing trading, is very difficult right here. There are some that are working, but for every one that's working, there's one that's not. That's the problem. So we'll see if this is reflected in the questions of what you guys are looking at. You can see the Dow here is setting up this little tiny base here. And again, I could care less what the Dow, what the NASDAQ, I don't care what the indexes are doing, even though I analyze them every weekend. We try to get an idea of where the general market's going. To me, it doesn't really matter. If the stocks aren't setting up, if stocks aren't working, then, I'm going to be sidelined. You want to go through some questions?
Yeah, with that said, first quick announcement, I just wanted to share based on some feedback, a suggestion that if you sometimes don't get your question properly either understood or answered by us, you may want to go ahead and before we start the session, so you're not rapidly having to type it all in super fast, prepare your question in, a Word document or whatever, and then just cut and paste it into the sessions when we're here. That works very well for people. So I did want to just provide that quick disclaimer. First question is from Michael, who is relatively new to full-time trading this year, 3-4 months. And I'll kind of just paraphrase some of what he's sharing, but he's asking when he's analyzing his individual results, how much of the current market environment would you be factoring in your grading? Because he's having a lot of, of course, losses and not having how to analyze his grading, I guess is kind of his question of what he should be doing over the last 3-4 months since he started
Grading the
full-time.
individual, like grading the trades, grading an individual
Yes,
trade, going back
yes.
and doing post analysis. Really,
Yes.
none. You shouldn't be factoring in the market at all. You should just be grading the trades, each trade individually, and just based on, whether it's you look back, was it a good buy? Was it a bad buy? Did you cut your loss too quickly? Did you hold the loss too long? Did you sell it too quickly? Did you protect your break even properly? Just go through all those things and see, and not based on the result. Not based on, oh, I made a good buy because it was profitable. Nope, that doesn't mean you could make a bad buy and have it profitable, and make a perfect buy and get stopped. And I'll bet on the guy making the perfect buys getting stopped all day long over the person making bad buys and getting lucky. So you have to be able to have some objectiveness and be honest. One of the things that I found that I like to do as far as grading the trades is to wait a while, like go back and grade your trades. In the beginning, you're probably eager to do it right away, and you might start looking at them right after you close out the trade. That's fine. But what I like to do is look at them, say 6 months later, so you close out a bunch of trades, and then on a 6-month lag, I start grading them. Maybe you do it, bi-yearly. And that 6 months later, you kind of mentally are away from the trade. You sort of forget about it, and you look at it more objectively that way, because you didn't just get out of it and you don't even remember the trade. It's almost like you're watching somebody else's trades at that point, and you can grade them, I think, more objectively.
Yeah. James is asking, does the altitude of the price structure above important moving averages ever enter into your decision to purchase or watch the pitch go by? For example, IRM is on buy alert. The 200-day moving average is 37% below the current price levels. No,
that doesn't. That's not going to really affect because that number, there is no set number that is like, a danger number. So you can have setups that are way above the 200-day and they work out perfectly fine. You can have setups that are right at the 200-day and they don't work out at all. As a matter of fact, when you set up right at the 200-day, I'm actually suspicious of it. Just like right at the 50-day, these very obvious areas, I'm more suspicious than if it was somewhat extended. Now, on a short-term basis, you can look and go back and see whether the stock is above its 50 or I used a 20-day. So if the stock runs up here and is way above the 20-day in the short term, you can go back and sort of take a look at maybe the last 4, 5, 6 peaks in the stock and see how far it was from the 20-day. And if you see, that, each time it's, 30, 40% above the 20-day, it peaked. That's a good spot to maybe, if you're a short-term swing trader, take some profits there, or start looking for, specific stalling and sell signals at that point. But that extended from the moving average, I would only use extended from short-term moving averages, not long-term. And I would only use it in the context of each individual stock. So for instance, one stock may have a lot of peaks at 20% above the 20-day. Another stock might be, if you're looking at a power play, it could be way above the moving averages. And so you got to take it, with a grain of salt there. So it has to be put stock by stock. There's not like a number that one size fits all, if that makes sense.
Oh yeah, for perspective relative to the pattern. Gary's asking on THRM. Set up on August 24th. He's asking, one, if this would be considered a cap pattern, being above the base.
No.
And if so, volatility seems to be increasing within the cap, the pivot reset above the base, or is this a post-earnings drift play, just with a low risk entry?
Yeah, this is just really a post-earnings play that, you had a big move up, and I'm very reluctant to play these short, what I call a short throw base after the stock is extended. I only play these on rare occasion. Lately, I've seen a handful of names that have set up like this. TPX is one. We've got this THRM, and still, so it got squirrely here. But after the reset and it came out, that's where where we bought it. If you take a look at Tempur-Pedic, TPX, another one. And if I do this, I want it to be coming out of a base and then have that big day, usually on earnings. And then again, similar, you see it came out, started to come out here and then came back in. And then, you know, this came very close to hitting a stop, but again, so this is still acting fine. So, you know, to answer your question, no, that's not a cap pattern, number one. And it's just a, you know, a post earnings play.
You had some other things written. I'm just trying to make sure that we covered those answers as well. So he's just trying to ask also with CCRN and ZI, if these would also be referred to as caps or post-earning drifts.
No, they're not caps. No, a cap is when you sit on top of a base, you break out of a base and then you sit on top of that base and you build a little cup completion sheet, like a little 3C or a little cup with handle right on top of the breakout, of course, to the right. And usually what happens is you break out of a base and then the market might correct or get heavy and start coming in, and the market's volatility or the market correcting holds the stock back, but the stock holds up above the breakout or pretty much above the, sometimes it'll come a little bit below the breakout, but holds above your stop and holds above the breakout and then sets up this little pattern. And then as soon as the market, you know, turns up, it breaks out. And so that's a cap pattern. I don't have any examples off the top of my head right now to show you, but no, this is not. I mean, and again, here you've got this big move on earnings, and then it just tightens up here, breaks out, and you just had a quick little shakeout here. But no, this is not a cap pattern. No. What was there was another one? Was there another symbol?
ZI.
Oh yeah, ZI. Yeah, so ZI. You know, another one where you know, this moved out on earnings, and now this is more of a cap type pattern. Okay, this looks more like a cap pattern where so you have the little mini 3C, little mini cheat area. It's a little bit ways above the breakout, but yeah, I would say that this, you know, you can maybe call this a cap. But it's just a natural reaction. You know, a cap is another form of a natural reaction. It's just a correction, a little pullback after the breakout. But I've called it a cap when they form these little patterns above. And usually, like the definition of you know, or the time I look for the, you know, cap type patterns is when the market holds a stock back that's trying to move.
Yep. Similar. Actually, Brian asking about NUE, if this would be either a fractal within the VCP or could this be a cap pattern?
A fractal, we're not within the VCP. The VCP is right here in the base.
Yep.
So here's your contraction right here on the right. This is your base. This is just a little classic cup with handle. You form a cup with handle. I bought it coming out of here. Now it had made a nice move up. Here's your first natural reaction, your first pullback, and we haven't recovered yet. So we wouldn't even, you know, we of course this is a pullback, but if this could get into new high ground, then we would say this is natural. All right, it's not natural right now. It's acting fine, so it's, you know, it looks like it's natural, but until it gets into new high ground, this is not officially termed a natural reaction. Natural means that it went through a pullback and it got into new high ground, and now, you know, that was a normal pullback, and the stock is moving higher again. So right now, this looks fine. I mean, this is, you know, if you're a, you know, really tight and you're short-term trading, you know, this is buyable here today as it pulls up from this little cheat area on a pullback buy. I generally will not play this because I'm usually already in coming off the base. So I'm not usually playing these, you know, these pullbacks. I'm looking to buy coming out of the base, and then I make my decision if I'm going to hold it for a bigger move or not, and usually go through this pullback, or I might, you know, just sell right into the rally and then step aside from it. But, you know, this is to get back on board. If I was looking to get back on board NUE, I would do it right here.
All right, John is asking,
Mark, I'm just sparing you because I know you don't feel good.
I'm here ready, you know, ready to help. So.
Yeah, I know.
John is asking on JBHT and AVY.
JBHT?
Yes.
Yep.
both bases, really tight pivots, room to make a profit before all-time highs, no recent attempt for all-time highs at the time of the breakout, and real economy stocks. Is this something of a theme right now? If so, how often do these themes change? Both have code 33s as well.
Yeah, I mean, I don't know if it's a theme. I mean, again, I don't overcomplicate things like that. I mean, if I'm looking themes and I'm looking for a technical themes, if you see a bunch of bases like this that are big bases, they're nice, tight right sides and they're breaking out, I would say, if they start working, then to me, that's a theme. I'm playing it, I'll play that theme. Sometimes you'll see a bunch of short bases and sometimes you'll see where you have bases and there's a shakeout and then a reset, and there's a lot of those. I can't really say, Mark, can you say that you're seeing a particular theme? I mean, the only theme I see is volatility and rotation and aggravation. That if there's any theme, I would say it would be aggravation. So, but technically, do you see any theme that we could latch onto, across the board here, with the technical patterns?
No, well, I would say no too, because the only technical theme has been the 2-3 day, the breakouts that have worked, it's been 2-3 day phenomenon at most, and then volatility. But that's not one you want to take advantage of. That's one you want to be cautious of,
Yeah. I mean, the only way to take advantage of that is like what I've been suggesting and doing is, you just sell into those,
right. Short-term trade them.
That short-term trade, that 3-day rally or so. And if you don't sell the whole thing, which then, sell a part of it if you're going to play it for a bigger move, and then sell enough to finance your stop. That's really, so I again, I'm not sure exactly. I'm not completely clear on the question, but this particular setup is textbook. I mean, this is a perfect base, really nice base. You got, again, and talking about fractals, this is a fractal. You have a little pattern. See the little tiny little coupled handle within the larger coupled handle. That's a fractal. When you have a pattern within a pattern, that's the definition of a fractal. What was the other one? AVY?
Yeah.
So AVY is another one where, I mean, really, this is just textbook perfect. Now what I'd love to see these patterns, I'd love to see this coming off of a bear market. So if this was a bear market, and then you see stocks like this coming out of bases like this, coming off the lows of the market, oh boy, like these could be like, the big leaders. Right now, I don't know, I think they're more tradable, but again, I'm looking for this, coming off a correction, and hopefully, this stock was one that held up really well during the correction and resisted it. And maybe this decline is far less than the correction itself, or, you'll see it let's say we're in a bear market. This stock in a bear market will look amazing. You want to know why? Because in a bear market, the indexes are below the 200-day moving average. In a strong downtrend, and now this stock is well above the 200-day moving average. See, in this particular situation, I mean, being above the moving average would be a great sign. If the market was below the moving average, that would be, that's what, that was Amazon in 2003-ish, 4-ish, where if you go back and take a look at Amazon, you'll see it was in an uptrend the entire time when the market was in this giant bear market in a downtrend. And then finally, when the market bottomed and came off the lows, Amazon was breaking out of a base, going into new high ground. And so again, you want to look for these stocks in uptrends and these type of bases during corrections.
Okay. Andy, your question about the analytics is something I'm looking into. I'll follow up with you about that separately. From Jack is asking, when doing post-analysis, his average gain and loss won't be consistent if I employ progressive exposure. He's asking based on the, weighted average, I guess.
Right.
And as he's increasing his size of his, but I'm not seeing what his actual question is. I guess he's just asking, how do you account for the fact that when he's starting small and has perhaps different win-loss, average gain, average loss versus when you're increasing your size, having average gain, average loss?
Well, the stock doesn't know, whether it's a big position or a small position, right? So the technical action, it doesn't know that, and it's not going to change. It's going to be the same. So the stock, if it's breaking out of a base and you're buying it and you buy a small position, and then 3 stocks later you buy a big position breaking out of a base, the technical decision or the way the stock's acting technically is exactly, nothing changes based on that. So the only thing that changes is your assessment of risk. So they're two completely separate things. So I don't track it on a weighted basis. I don't track my trades. When I grade the trade, I just grade it as a position, whether it's a small position, big position, that doesn't come into effect with me. And even, performance wise, like an average gain loss, I'm not weighting it, because again, from the breakout level, whether it's a small position or not, again, what I'm looking at is the technical factors and how I'm treating the trade based on that. Now, another reason why I don't do it is because I did for many years. I weighted the performance. So I would weight the stock based on the position size, and then weight the gain, or unweighted if it was smaller. What I found was over time it kind of washes itself out. Sometimes you have a big position when you're a bit lucky. Other times, you have a small position when you're unlucky, and vice versa. Over time, it seemed to wash out, and it never really made a huge difference. So I said to myself, well, why should I go through all this work if it doesn't really make much of a difference in the long run? So that's how I came about that, for two reasons.
George is asking, yes, George, I know, I do owe you a call back as well. Thoughts on Lulu? Tom is asking, as a pullback buy on August 23rd, would that qualify as a pullback buy?
On Lulu on August 23rd.
Yes.
Okay, so that's well, okay. So first of all, a pullback buy, as far as that I define it, okay, is in a base, right? So I mean, yes, did this pull back and set up in looking at a microcosm here and looking at a little, just this few days? Yes, this was a pullback buy. However, that's not how I use a pullback buy. I mean, you certainly could, it came back near the 50. I like the way it didn't come and touch the 50. Just a quick note, I don't like when stocks, are so textbook that they come back and they tag the 50. I'd rather have it be above the 50 and set up the pullback buy. That shows a little more strength and keeps, all those sitting there waiting for it to touch the 50. They never get a chance to even buy it because it never touches the 50. So I like that. And you can play it on a pullback to the 50-day or whatever respective moving average. But for me, a pullback buy where I use it is within the base. So it would be like over here, like right here. So you're coming out of this base here, forming this big VCP. You tighten up on the right side, and as you start to turn up here, this is where I'd start buying through the pullback buy. And in a situation like this, I'd probably buy a part of my position. Now the stock actually breaks out here, and I'm maybe underweight, pulls back a bit here, you get another little pullback buy, maybe add some more there. So this is a way where you can get ahead of the breakout a little bit. Now if things are setting up great, everything's working, I might take my whole position at these pullback buys. If not, and I'm just starting to put my toe in the water, I'm probably taking partial positions, and then I'm pyramiding and I'm building into positions. So it kind of depends. Again, you have to assess the situation. But yeah, this is a pullback buy in looking at it, like I said, in a microcosm. But again, I use them in the base, or I also use them. I'll use it if it pulls back, just breaks out and then pulls back to the top of the base. I sometimes use a pullback buy on the first pullback to the top of the base.
Eric's asking, so if after you have taken a pause of your trading, having an extension of losses in a row, how often do you get back in to try your next pilot buys?
Yeah, well, that sort of, takes some feel. This is probably a good question for you, Mark, as well. So, you got to sort of feel what's going on and see what's setting up. And if you see that, you're going in there and there's, there's different scenarios. Sometimes there's not a lot of setups and they're not really great setups, but you take a few because, they're borderline. And then other times, like we had just recently, not long ago, I mean, it was probably the largest buy alert list that I've seen maybe in the entire time we've been doing this, for 11, 12 years that we've had Minerva Private Access. The list was huge and there was a bazillion stocks breaking out. Now, I took advantage of that because, as you know, I was selling them very quickly into the breakouts, as you broke out that first, few days. And that turned out to be the best course of action. But if you were swing trading, I also have never seen so many failures. So, now that was a time where, let's just say you had 4 or 5 trades that didn't work. Well, there was still a whole bunch of stocks setting up. So now maybe, okay, well, there's still stocks setting up. So I take some more trades. Maybe you question your buy techniques and you try a few more from a slightly different angle, and those don't work. So at some point you have to say, okay, this isn't working. This is the theme. The theme is that these stocks aren't working. So your question is, when do you sort of, re-up or re-enter the market? Well, it depends on what the damage is. Like if I'm getting hit pretty hard, I'm gonna wait longer. I'm gonna be more careful. I'm gonna come back a lot smaller and more, and I'm gonna try to rebuild a lot slower. Just think about it. If you broke your leg, you certainly wouldn't start running the next day, right? You'd have to go through some therapy and use crutches, and it would take time, as opposed to if you sprained your ankle. It might be a lot quicker that you're back on the track, if you will. So you have to take a look at that. I'm looking at the downside. What kind of risk do I have here? If I'm in the hole, then I'm going to be really careful. The other thing too is you can maybe take a step back and then watch what happens. You have a buy alert list, you have a whole bunch of stocks, right? And you're itching to participate in some of these, but you just got clipped a bunch of times. Well, let a few pitches go by and see how the stocks are acting. Is that theme continuing, or is there been a shift? There's been a change in the winds, so where now things seem to be working a bit better. So you don't have to participate necessarily to watch. What about you, Mark? If you're getting clipped and you're getting knocked out, how do you get back in? And what is there any type of method to that madness?
Well, I think normally I'm always just looking at the quality of the setups too.
Yes.
If there's quality setups, and we've this has been the Godfather nickname, in terms of the market just hasn't really slid hard enough to reset a bunch of stuff. So it just kind of keeps dragging you back in and showing you a few setups, just enough setups to keep you interested, but also to potentially get you in trouble, at least if you're, like you said, trying to plan for swing trades has not been a profitable endeavor. So yeah, I would say it's different every time. This one has been more unique though, because it just seems like when you think we're going to maybe roll a little harder and get a little more of a reset, how many times has the Russell tested the lows of that range in the last 6 months, where it looks like this thing's really going to roll over. It may still, I don't know.
Yeah.
A week and a half ago, I thought we might really crack hard and we didn't. So, but like right now, I would say I'm trading as small as I've traded in a really long time. So it's either you shrink your size and then I get a lot more selective. So think of it.
Hold on 1 second.
I'll just finish my thought there in terms of if I'm a hitter, I'm waiting for a really good pitch. I'm not just swinging at anything. I'm looking to just make contact with the ball.
Hey, real quick, I'm sorry to interrupt. I have to take this call. It's my attorney that I've been waiting for. Can you guys just handle this for just a minute?
Yep.
I'll be right back.
So question with Kirill asking, when filling out your post-analysis report card, are you looking at your trades in a total vacuum just to see, or are you also taking note of the market conditions and the environment of trading that you might be trading in hard penny, easy dollar?
No, man, Mark just covered this earlier. I think you just want to look at them on a trade basis alone, like in a vacuum, i.e., would I take this trade? And I think Mark's point too about giving it 3 to 6 months is even better, because sometimes you come back and you go, man, why did I even buy this name? Because you're a lot more objective in hindsight, the further hindsight. But no, I just would recommend, and I know Mark does, just look at the trade. Was it a good buy, a bad buy? Was it early? Was it late? Grade the buys and then grade the sells.
Question for you, Mark, is someone is asking your update on your RADI stock. Are you in RADI still?
No, I am not. I took half at about 10% gain, and then I moved my stop to even and got tagged on the rest, which has sort of been, that's been a good trade of late for me, where you can peel off a little bit, move the stop and de-risk the trade. Was trying to play the rest for a bigger move, and there just haven't been a lot of bigger moves to be had.
All right. Let's just see here, Chris. Yeah, just asking on these reversals, when a stock breaks out from a perfect VCP, where does all the supply come from when it's failing? Is it institutions waiting for the liquidity to sell into?
Certainly, if it's above average volume, most likely it is absolutely institutions that are potentially, using that strength to rotate out of a position.
I can't pronounce the name, but is asking, do you hedge your positions over the weekend if you're fully invested when you do not have much of a cushion of profits, like if the market is nervous circumstance like now? Do you ever do that?
Well, you shouldn't, for starters, you shouldn't be fully invested without a cushion. That would imply that you're not doing progressive exposure properly, because when done properly, you're only fully invested after you're leaning on profits, either open profits in positions you already have, or in partially booked profits. So that's sort of half the answer. The other answer, though, is no. I don't hedge. On occasion, I might put on. Let's say I'm very long, and I think the market might come in sharply. I might put on some type of a proxy hedge, say an index, or take a short again, a large short against my positions. So say I don't have to sell everything if I'm getting a little bit nervous, but that would be in a period where things have really been working. Progressive exposure is working well, and I've been having a good period, say for 3, 4, 5, 6 weeks, and I'm still pretty heavily invested.
Yep. And same kind of answer. You should, have either a cushion, or you got to be comfortable with the amount of risk you're putting on with your open positions. Otherwise, you're not following perhaps your own risk management rules. Trying to pick a question that won't require Mark to be showing the chart of it. So let me move down here a little bit. Okay, Andrew's asking or mentioning that he's finding it very hard for him to re-enter a trade after getting stopped out. What would be the best suggestion to overcome this issue?
I think he's referring, Bob, to say, so let's say you buy a name like Square, and it stops you out, and then it sets up again, which is the potential situation we have now. It stopped out, and it may be setting a right side again. Well, that stock doesn't know that the stock doesn't know you, guys. This idea that, and you hear novices say this kind of, oh, I don't like that stock. It stopped me out 2 other times, and it might have been 3 years ago and 5 years ago. Like, well, the stock doesn't know and doesn't care. That's just a form of being irrational. The question should be, does it meet the criteria? Is it a valid entry point and an acceptable low risk entry? If it is, then you want to potentially, entertain it for purchase. One more point, though, is think of it in terms of, this is why I like the failure reset, because every novice who thinks that way is not going to be buying it again, because they're worn out, they're tired. They go, oh, the stock doesn't like me. Well, great. That means there's even less potential people buying it this next go round, which is why sometimes the failure reset is a better buy than the initial one.
Yeah, it comes down to having a plan, which is what Mark's referring to. We have a plan when stocks stop us out and reset to get back into them. And we know our plan is a profitable plan. So having the criteria being met, being very, not taking it personal that the stock might have hit you over the head a couple of times and banged you up. But the idea is what I also would just reiterate what Mark just said, those resets tend to be even better trades because they're more constructive now, particularly after having just shaken out a number of people like us previously. And that's exactly where they do tend to work even better. having a little more confidence with them, having gone through a better development. And trust me, once you get a few that do go on to become winners that you get back into, you'll very quickly realize the value of having a plan that you follow that you know is a profitable plan. On TPX, even though we can't pull it up, the question is, why do we have two stops that are very close to each other? And maybe you can just explain they were two different setups, two different entries, Mark.
Yeah, that's right. TPX just set up again. So, there was sort of a second stop for the second entry, almost like, two trades or two legs of the trade.
Yeah, it's ultimately because each stock has its own merit or is an entry based on its own merit. So it has its own risk dynamic with each one. And even though it is only 10 cents, which is in this particular case very close to each other, you could choose to just use the one if you choose. Or why it was more important that Mark was using it is if you didn't get into the name the first time and just entering the second name, well, that's where he's using the stop separately for those people that just may have bought the second time. Okay. Actually, Joe, you asked that question last week that I think Mark answered pretty thoroughly last week. So just go back and listen to the question and answer session from last week. John's asking, how long do you stay in a trade if it's proving basically a time stop, just hanging out there with very little performance? He's sharing DFS or COF stocks we've been in for a few weeks, not really doing anything.
I would not suggest time stopping anything out that is not doing anything wrong. So now but again, if your plan was, I'm expecting this to go, say today, or, like very quickly, then you should have known that when you got into the trade. If you're new at this though, and stock broke out and, maybe it's pulled back to the breakout and it's just sort of, biding some time, I wouldn't, but there's no violations. I wouldn't sell the name. The only time I would sell a name like that is if other things in my portfolio are working really well and there's other setups, and I may want to potentially, jockey for position. I don't want to take more overall risk. So I sell the name that's just kind of, biding time to buy, a different setup. But again, I think that's a little more of an advanced technique.
Yeah, I think Mark shares for relatively new traders, you really would not want to be employing that because you're more apt to make a decision without having the experience that you're going to develop by following Mark's plan. And his rules would be let the stock play itself out. Either, get up to a point where the price action warrants taking some profits, or it triggers the stop on the downside. Also, what I think Mark just referenced is how many other names are there setting up that you could be redeploying that capital to would be a factor. And if it is even for more experienced players, you may want to take half off that position, even though it's not doing a whole lot. It just might be biding its time and sure enough, ready to go. So take half off if you want it to get into a new position that might be also setting up ready to go. If that's another way to, redistribute some of your capital. Seems like you're always buying the strength if you miss it. Michael's asking, as a new member, he's noting that it seems like we're always buying into strength, but if you miss a breakout and the stock goes up a few percent and pulls back to the pivot, do you buy it? Okay, this is our standard weekly question, seems to be. Quick answer with that.
Yeah. Oh, you mean should we buy it if it comes back to the on a pullback? Well,
after going up just a few percent.
Yeah, just a few percent. Listen, ideally you shouldn't be missing them if you're doing your work properly. But of course, can that happen? Of course, sure. Or maybe the stock comes out so quickly you go to buy it, you only maybe get a partial fill or something like that. If it's orderly, and this is where I would say, if it's only a few percent, I still wouldn't just blindly buy it. Say put a limit order in there back at the breakout. I would want to see it. I'd ideally like to see it hold above the breakout, and then I'd buy it as it starts turning back up on the intraday. That's how I would handle it.
Yeah. Some of Mark's stock screeners and Marcus Smith yield hundreds of stocks. How do you recommend adding an additional filter that would pare down that list? And he's making a suggestion. This is Brooks, filtering relative strength of 80 or above as an example.
Well, for starters, in the screens I run, and I know it's funny, Mark and I have never actually compared screens, yet we come up with 90% of the same ideas, if not sorry about that, every day or week. So I don't think you want to add too many criteria. You want to have, say, several hundred names that you're sort of screening through every day, because that's what's going to sort of perfect your eye and your ability to spot some of these. And too much criteria, then you'll wind up missing some names. But there's nothing wrong, an RS of 80 or above. I think that's fine, with the exception of IPOs. So because IPOs, I use an RS quite a bit lower, and anything, say, that's recently IPO'd in the last 2 years or something like that. But 80 or higher, I think, is not a bad rule. And then I wouldn't go any lower than 70.
Yeah, I think the key here, Brooks, being new especially, is when you get proficient at this, and you're only going to get proficient at this by doing the screening, of hundreds and hundreds or thousands and thousands of names, to be able to get to the point where you can, within a matter of a second or two, literally that quickly, be able to recognize a stock that's worthy of more interest, more attention, or there's no way you'll ever buy this name, so just cross it off your list and move on. And if you do that, even with the name of 500 names coming up on a list, truly, that's something that should only take you about 10 minutes to go through. And you'll check off the ones that you identified to being worthy of another moment or two of your time. But you want to see all 500 names, because the whole point of this is it is ultimately your eyeballs that are the final filter. It's not another algorithm or another filter metric that you're putting into there to find these names. These names aren't found algorithmically. They are found because you develop the skills to identify them with your eyes. And you need to develop that skill for one day when Mark Minervini and Private Access is no longer around. You have the skills to be continuing to do this for years and years or decades and decades. So don't try to simplify the process by finding a green button, red button type of mechanism. That's not what this is about. It's having the skill sets that you develop by doing the work hundreds and hundreds and hundreds of times over till you get that, your eyes to that point. Jeremy. Okay, just referencing the stock. I can't pull up with Mark not here right now. Pratesh is just asking real quick, when Mark refers to getting a bad fill, what's the telltale sign of a bad fill?
Okay, that's pretty
Sorry,
easy.
guys, I'm back.
Oh,
Okay.
well, we'll let Mark give his definition of a bad fill then.
A bad fill?
Yeah. What's the telltale sign of a bad fill when you say you got a bad fill?
A bad fill is that you got a price, that was above where you wanted to, get in at maximum. Say you're looking to buy the stock up to, 220.20, and you get filled up to 220.90. So now you've got that's called slippage. So you'd have 70 cents of slippage. Same thing on the downside. You try to get out of a stock and it's falling very quickly, and maybe your stop's at $100, and you end up getting out at average price of 99.10. You got 90 cents of slippage. So you're going to get slippage. That's going to happen. That's part of it.
Mark, do you also, this is sort of I would consider a bad fill too. Well, it's not technically a bad fill, but a partial fill in the right direction that doesn't come back your way. So say I go bid 10,000 shares at $20 and I only get 3, and the stock just takes off.
Okay, so now that's talking as far as size, putting on size. So that's probably what you're referring to when I talk about, I'd rather get a bad fill than a good fill. That's maybe that's where this was coming from. So yeah, so if you say you go in there, you look to buy 10,000 shares, and you're willing to pay up to 110, and you only get 3,000, and the stock gets away from you, and now you're left with a smaller size than you would have looked to get in. So that would be also the definition of a bad fill. Absolutely. I generally look at a bad fill as price, but size too. Absolutely. But I'd rather get a bad fill on on size than a good fill, and it gives me especially if it's a lot of size. If you're going there with 100 shares, even 1,000 shares, you're not going to really gauge this the same way. I mean, if I'm going in to buy 50,000 shares at the offer of a stock that trades 500,000 shares a day, and I could get it at the market in one shot, that's not a good sign. That's an awful lot of supply. You didn't move the stock. You want to see the stock move. If you're buying any type of size, you even if the stock's ready to go and you're really coming from a super tight pivot and the volume is really contracted and everything is perfect, you might move the stock on 500 shares. It might jump up 10 cents, 20 cents, because there's no supply there. And that's what you're that's exactly what you're trying to accomplish. You're trying to find that area where it's what Livermore would call the line of least resistance, where the stock can move very quickly and there's a lack of supply. So even a small amount of buying can move the stock.
Okay. AXON is showing VCP in the load sheet today. Ramashing is asking if this would be a load sheet buy today.
AXON?
AXON.
A load sheet. Well, this is a load sheet. If you were to look at this here, which is, I don't know, 5, 10, maybe 15 days, but that's certainly not a base. So you can say this is a load sheet within, a big cup with handle, if you will. I'm not sure how big this decline is here. About 43%. I mean, this is viable here. It's this is just breaking out, not into new highs or above this level here, which would be extended from this pivot. But here's your pivot. This is your pivot right here. So yeah, it's I'm not sure what the exact question is, but this is coming from a little load sheet within the handle.
If it's viable today.
Yeah, I think it's viable. If you're interested in this name, this would be where you would buy it. You'd buy it coming through this pivot.
Jeremy is asking, and Jeremy, I left you a voicemail message, so I do need to talk with you. But Jeremy is asking DXCM, if that would be considered similar to ZI.
I'm sorry, DXCM. DXCM, similar to which one?
ZI.
Not really. No, I mean, with this one, this is really just wedged its way all the way up, and then got very extended here. This is the type of thing that I generally try to avoid. When you get an extended stock that then has a big up day and then sets up extended like this, I have not had a lot of success with these. They seem to wiggle more and stop you out a lot higher percentage of stops. Could it work? Yeah, it might work. But like I said, if I went over 100 trades of this type of setup, this would be one that I generally would stay away from. But is it like ZI? Let's bring up ZI, show you the difference. So ZI is coming out of a base here, and it's still not way extended from the base. And then you've pulled back right to essentially the top of the base right here. So this is more of a cap type situation where you're setting up right on top of the base, and it hasn't really made that big move yet.
Renee is asking if you could talk through the SHOP name put on buy alert this morning. And she mentions that it was reviewed a few weeks ago. And just trying to get some insight, and a lot of other comments, by the way, from her as well as others.
Yeah, again, this is getting away from where I would, want as the optimal buy point, which would be coming out of the base here. And here's the cheat area. So you even got, here's the cheat within the cheat, right? So you got this little pivot right down here, we talked about this before, and as it turns up here and then it gets through, makes the turn, and now, breaks out, sets up this sloppy handle, and now it's sort of all over the place. This is sort of a reset here. I think Mark Ritchie, this is one that he was, I think you put this on, right, Mark?
Correct.
Yep. So you can, I mean, if you want to explain it, you could explain it certainly.
Yeah, well, just trying to tighten up. I mean, I like this group, but yeah,
This is
it's
a
not.
weekly.
Yeah, it's not quite there yet.
Yeah, and I think that, Mark's right to look at some of these, these bigger cap, what I would put this in the category of the FANG names, because they were working. My money keeps coming back to, these big cap leaders. And again, optimally, I'd like to buy right here. Even on the weekly, you can see here's your pivot, here's your cheat area, nice big breakout. But since then, now, you've put in a bit of time here, and this would be your next, buy point. Would it be optimal, as far as the first chance that I got to buy it? This would be the first chance that it's set up. If you look on the daily, I wouldn't be looking to buy it at any other time here, except over right here on this right side. And now I wouldn't be looking to buy it at any other time other than right now here, if I missed it here. So these are the 2 points at which, we'd be looking at this.
Question on JILL, very thinly traded stock, but if you have a smaller trading account, would you have any problem with trading a name as lightly?
I wouldn't
traded
have a
as this?
problem with the large account as long as you adjust for the, for the volume. This trades about 66,000 shares a day. So this is super thin. So no, I wouldn't have a problem with it. If, again, the optimally, I'd be looking to buy it down here. I mean, you can see right here, this is a really nice, well-formed, you got a nice tight pivot here. This is a similar situation where you come ripping out, right? And then you form that first little pattern sitting on top of it. And then you can see how efficient that move was, really set up nice. Now, we're getting a bit, this is getting a bit sloppy here. And I see what you're looking at tight here. It's not on my radar, but again, if you were to buy it, you'd buy it coming through this pivot right here. And, you just got to position size accordingly. The stock trades, 60,000 shares a day. I'm certainly not buying, 20, 30,000 shares of it. I'd be half of the average daily volume. So you just got to, adjust for that.
Yeah, that's only $1.2 million of market buying
Yeah.
and selling.
Yep.
But that can work well though.
Yeah. I mean, I go in these names, I go in super thin names, but I'm super small, that's the bottom line. I mean, you see sometimes I'm buying or putting on stocks that are super thin. I'm just buying very tiny positions. And sometimes, I'm not even buying them at all, but if I do, it's going to be adjusted for the level of liquidity.
Eli's asking that he notices a lot of the daily range of a lot of the quality breakouts happen in the first 30 minutes of the day. How does Mark short-term trade with stocks that are breaking out first thing in the morning, when typically that's where the spreads are large and the volatility is the highest?
Well, I don't agree with that. As far as the spreads being the largest in the early in the day, I that's not something that I think you're correct on. So I don't think the spreads on a stock that has a spread that's, trading, let's just, whatever stock, we'll just bring up, Goodyear tire or whatever, it has a penny spread, 2 penny spreads. It's not like it's going to have a 20-cent spread in the morning and go to a penny spread later on. If that changed, I mean, that could change just the opposite. It could have a tighter spread in the morning and a wider spread later on. So I don't know any scientific evidence that says that's true. As far as volatility is concerned, breakouts are not volatility. So if the stock is moving in one direction and they're breaking out, that's not volatility. Volatility is back and forth. So you tend to get, a lot of action. Yes, does happen in the morning. But that's also a function of the market. I mean, I've seen markets where it's very quiet all morning, and an entire, theme for 6 months or a year in a bull market is late day breakouts. So I think that is also thematic and a function of the market, or a function of, the time in history. That could change too. So I wouldn't get too stuck on, a certain time of the day. When the stock sets up and it breaks out, I buy it. So you start getting into all these like preconceived notions. All you have to do is that find a stock that has the base, that's in a tight pivot. When it moves to that price, you buy it. You set a stop. If it hits your stop, you're out. I mean, there's not a whole lot of moving parts there, but you start trying to figure out when the spread is wide, when the volatility, what part of the day I should be trading, what name I should trade first and ignore the other one, what group is the strongest group, is the market in a bull market, is the stochastics, below 30, and you'll never do well at this. You'll be all over the place. So I look for stocks and bases, and when they get through the pivot points, I buy them. If things are working, I step up my activity and I push it. When they're not, I pull back. Repeat, rinse, repeat. You don't have to overcomplicate it. It's that straightforward. I mean, look at JBHT. Here's a perfect example. Look, I'm not even thinking of this stock until it starts, let's just say I'm looking, I'm screening. Now, maybe over here, I might start looking at this stock. I got a cheat area right here, right? So it gaps out. So I'm not going to trade that, right? So now, okay, it comes in a bit here. It's getting sloppy and squirrely. I need it to tighten up. Now, this is looking at this would go by day by day by day. This would take a while, right? So now over here, right now I'm starting to look at it. It's starting to set up that right side. You got a pullback buy here. Maybe you could start a little on this day, but now, okay, it gets even tighter. Oh, and this is really starting to look nice now, right? Okay, now I'm ready to buy. Now this is tight enough on the right side. Look at the volume. Volume came way down. I've got a fully formed base, and I've got that fractal. I've got the contractions. 1, 2, 3. Okay, boom, there it is. Now I'm ready to buy. This starts turning up. I can make a decision. I want to start buying it to the pullback buy, take my whole position, or maybe take a part of it. And then when it finally breaks out and gets to the high here at 176.93, follow up on it. Or do I want to wait and get a little more confirmation and just wait for it to get through the turn and buy it there? That's the only decision I have to make of what part of this pivot point, whether I'm playing the pullback buy and I'm going to buy my whole position, or if I'm going to wait and let it get through the turn. There's really not much decision. Now at that point, that's it. I set my stop. I'm going to set my stop. If this pattern, if this price action shows me an area where, it would be abnormal, which here you'd really want this low here on 819 to hold. So that's 173. I'm sorry, 170.05, right? 170.05. So on that JBHT, that would be probably my my maximum stop at that point based on technicals. But now I've got to measure that. Okay, so from my purchase, where is our purchase price on this one? Where is it? 176.40. So from 176.40, right about here, down to that level, okay, is about 3.65%. That is a really tight stop. So see, in this, I'm not going to give it 6, 7, 8%. I don't have to. It's telling me that it's not acting right if it takes out this low. Now, if you want to get cute and you say, okay, I want to, maybe this will shake out some people, and maybe you can give it the full stop. You want to give it a full 8%. That'll give it a lot of room and let this low shake out. But I wouldn't do that in this particular scenario. If this comes back, takes out this low, I'm out. And so that's the process. That's the process. If this is working, like right now, this is great. Breaks out, closes near the high, second day following through, wonderful. We don't see a lot of volume though, but I'd like to see that volume come in at some point. But even if it doesn't, that's fine. Stock's profitable, and we'll stick with it. If I get a couple of these names that are working out, I'm going to buy a few more. I'm going to start moving my size up. If this comes crashing in, stops me out, I buy another few trades. They come in, stop me out. I'm going to pull back. I'm going to trade smaller. And I'm going to rebuild. That's it. Same thing. I've been doing that for 37 years. And it's been working like a charm for the last 31. I had 5 or 6 years in the beginning where I didn't know what I was doing, and I didn't do this very well, and I didn't make any money. And then it's all started to turn around. And for 30 years, this hasn't failed me, not yet.
Thillo is saying when you getting back to the bad fill, you get filled and you find that your purchase price is now 2% above your pivot. How do you handle that? Do you tend to reduce your size because of the bad fill?
If it was an overweight, if I was, really, trading really aggressively, I might just, so let's put it this way. Let's say it gets extended and the stock starts stalling and moving against me. How I'll handle that sometimes, I make a mistake, let's say, somehow I back myself into a mistake. I paid too much. It's extended. Sometimes what I'll do is I'll just set, because sometimes you'll overshoot. You'll get a bad fill, but it'll move even a little bit higher. So now you're okay. You're up a 0.5% on the trade, but you paid, whatever, $1 more. What I sometimes will do is just set a stop on that difference to adjust for the larger position, or the position that got extended. I'll adjust for that with size maybe, but I'll put a stop where that break even is. Or sometimes I'll just break even the whole trade. I chased it up and now I paid way too much and I got a bad fill and it overshot a bit and it ran, I might just put a stop at break even and say, you know what, if it keeps going, great, but I'm not going to lose any money on this trade. I'm not going to let this thing come in, because when it's extended, it could very easily come in, several percent. And I might not want to risk that. So I got to look at my position size, how much I'm willing to risk. It all comes down to what you're willing to risk. So if you think that pullback is now going to be excessive, you may want to just step aside, and say, okay, it's a mistake. I'm lucky to get out of here break even, or I'm lucky to get out of here with a little profit, and just cut it and move on to the next one. So it depends, though. I mean, very often that's how I'll handle it.
Gotcha. Nancy is asking if you are.
How about you, Mark? Wait, I want to hear what Mark says about this. So if you get a bad fill, and you're you paid up for it, do you adjust for it, or you just chalk it up and as slippage and stick with the plan?
It doesn't happen that often anymore because I generally kind of pick the price I'm willing to go to.
Right.
So I tend to just go, if I'm willing to pay 1% over the pivot, I wouldn't use a market order. I would try and buy everything up to that spot. You know what I mean?
Yeah.
Rather than, that's kind of how I, back into it. But yeah, if that were the case, I would definitely adjust for it on the other end. So yeah, on that portion of the position, I would add that back to potentially the stop, I guess.
Right. Yeah. And I don't generally get hosed, that often. Occasionally, yeah, it will take off and get away from me. And it usually be on a smaller position, because even if I'm buying a large position, let's say I'm trying to buy, 30, 40,000, 50,000 shares, I'm usually buying 5,000 at a time. So what'll happen is it'll be on part of the position, because I maybe I go in there and the first 5,000 at the market and the thing just blast off. Well, I don't get my whole position on, and I may get, I may pay up for it, but it's on a small portion. Or let's just say, I'm buying at 5,000, 5,000, 5,000, and it doesn't move. And then my last 5 or 10,000, it blasts off. So again, I would only get hosed on a portion of the trade. So it's going to be very seldom that if you're over there, you're buying 1,000 shares, or even, maybe even 4,000 or 5,000 shares, that's going to happen where you get so, murdered on it that you're in that bad situation.
Nancy is asking if you are trading or just day trading these days, or are you still having swings as well?
Well, I tried some swings, and each time they just don't seem to be panning out. So I'm definitely short-term trading, the grand majority of the time, and certainly with partials. I haven't had any swing trades that I haven't financed the risk. Let's just put it that way. In quite a while. I'm definitely getting out of them and financing the risk. I'm going to hold overnight. I'm trying to sell some out, and if they move against me, I'm getting out very quickly. So I think on both sides, being faster, keeping my loss, really super tight, particularly on size. Again, if I'm taking a smaller position, and I'm way underweight, I can afford to give it some room, and I can even afford maybe to go overnight. But on a big position, no. What I'm trying to do is I'm trying to trade so large that a small position is like a big position. Again, if I make a 5% move, on a, just say, your normal position size is 25%. And you make a 5% move, you go your whole account into one stock. Intraday, stock runs up and you're up 5%. Well, if you sell that, you take that 5%, it's the equivalent of 20% at your 25% position size. So I would accomplish the same thing of swing trading a normal size position. So now someone greedy might think, okay, well, I can make, that 5% will be the equivalent of 80% if I let it go up to 20% that I would go. Yeah, that's true. There's also the risk side, so I'm not greedy like that. I'm looking to just inch my way up and chip my way up. So that's how I approach it when I'm trading the shorter term. I'm usually trading larger when I'm trading the shorter term stuff.
All right, a few more questions here. How do you guys stay so focused and optimistic when you go through a difficult period in life outside of trading? Oscar is asking.
How we stay focused on trading?
Well, and I presume an optimistic on trading when you're going through outside, distractions or.
Well, I mean, if you're, I don't know, that's certainly a relative term. I mean, it depends on what that distraction is. I mean, it could be a distraction or it could be, complete disaster in your life. I don't know, but I went through, my mother had terminal cancer, and I laid by her bed in the hospital with a laptop and traded every day. So, my father died when I was 26 years old, right in the middle of me trading in a very active market. And I traded through all that. It was, it was the surprise and disaster of my life. It was very sudden and unexpected. So, I mean, I traded when I got very sick at one time and traded through all that. So I don't know. I kind of, to me, the trading is not, it's sort of like riding a bike to me at this point, and it has been for quite some time. And my wife's like sometimes amazed. She's like, you can go in there and you can trade regardless of what's going on in your life or how you feel. You're such a consummate trader that it's just second nature to you. She's often blown away that I can do that, but I don't know. I mean, and I think, Mark, your answer would be, I don't want to answer for you, but I know we've talked about this before. You really probably shouldn't be trading. You should take a break if you're having turmoil. I recommend, you want to be clear and you want to really be able to focus and not have distractions, emotional distractions and so forth. So, if you're new at this, it's going to be very hard to trade stocks if, you've got a lot of turmoil in your life emotionally.
Did you want me to answer that, Mark?
Sure, you could. Absolutely.
Well, says the guy who's recovering from COVID right now and still trading.
Exactly.
So, yeah, I think though everybody's a little different. And to Mark's point, if you're new, I definitely think you want to. If your head's not clear because of something in your personal life, I would definitely suggest potentially take a step back in your aggression.
Right.
Step back your size or that type of a thing. I heard Paul Tudor Jones once say he had a rule that whenever one of his managers was going through a divorce, he redeemed automatically and then sent the capital back once the divorce was over.
Yeah.
I don't know, he's one of the all-time greats. But, again, everybody's a little bit different. If I was going through a personal tragedy, I would probably take some time off. I've traded through, my wife having all our kids and getting very little sleep and selective illness.
He's got a lot of kids.
That's because I have a few. Yeah. So but those weren't, to Mark's point, they weren't destabilizing, and I think Mark's been doing this long enough too, where, he just knows there's nothing that's going to get him to break discipline, regardless of what's going on in his personal life. I kind of feel the same way.
Yeah,
if I'm just feeling crappy though, I might just go, you know what, I'm going to take some time off and that type of thing. So
yeah,
it's not a concrete answer, but I think we're probably on the same page, Mark.
I personally think if you're breaking discipline because you've got, some problems going on, that you just have poor discipline to begin with, because quite frankly, if things were going, really bad in my life, I'd be even more disciplined. I would tighten up even more and realize that I'm prone to, making mistakes, and I would be even more careful. So again, that's, like I said, if you're new at this, you definitely want to, you want to have a clear head. And, people are so worried about trading. They want to get in there and they trade it all the time, and it's okay. If you miss some trades and you miss some time in the market, it's going to be here. I trust me. When you come back, it's all going to be here.
Yeah, that is the nice thing. The market is always open.
It's not going anywhere. I assure you that. It'll be here long after we're gone.
Let's just see here. As a quick follow-up to the Shopify stock setup, would you rate that as pocket tens or jacks?
Yeah, I mean, to me, this is definitely not aces or kings. Yeah, I would probably have this as a mid-level hand, and tradable. Again, here's the other thing too. As you go down the scale of, or I should say, down the time horizon, and you have a shorter term time horizon, I don't have to have things as perfect. When you're looking to play for a bigger move and you got to go through pullbacks, then you really, you need to be, you need to have more perfect setups. Stocks can go up 5-10%. Every stock fluctuates like that. You can sometimes just play pullbacks, and just from the pullback buy to the top of the base, the high on the left side of the base, is a 10% or 15% move. So, again, depending on your time horizon, day traders, that's a whole, you're talking about trading very, very small increments. And then, the setup becomes even less, certainly on a daily basis. You might be looking at intraday setups at that point and grading them from that standpoint. But to answer your question, yeah, I would look at this as a mid-level, hand.
Okay, let's see.
I gotta wrap it up. We can have one more question and then I gotta go. But and
Okay.
I guess we've been going for about an hour and 15 minutes, so it's time to wrap up
Yep.
anyway.
Constantine is asking, when can we expect the Mark Minervini autobiography book?
I don't know. I've been approached for that several times, so I certainly could get that published if I wanted to, but not for a while. But they're probably going to do another book. Thinking about doing a book on sort of just the rules, like maybe the top 20 rules or something like that, to sort of make it hone it down even more. Like my first book had fundamentals and a lot of things in it, and then the second book left off, picked up where I left off, and then sort of distilled it down even more. So now, the next book would be even more distilled, where I would just talk about, maybe the top, I don't know, top 10 or top 20 rules and something like that. So I've been asked to do that book too. But again, pretty much everything you need are in those first two books. My two books have pretty much A to Z. And certainly if you do the Master Trader program and you're on this platform for a year or two, and all that together, you just nothing else you need. Maybe read O'Neill's books and that's it. I mean, anything more than that, you're complicating it. You're looking for, for something to do to work for you, but you have everything you need. And all you need to do is just practice and keep with this. Everything's there. Far more than I ever had. That's for sure.
Well, we can wrap it up there. So again, as always, guys, we try to get through as many questions as we can, but save your questions for next week that we didn't answer. And again, try to prepare your questions before having to last minute type it all in very quickly to the chat box.
The Master Trader program is coming up. So you should definitely, if you have not done the Master Trader program in the past, we have people that have come 7 years in a row, but I would certainly do it one time. And I assure you, it is without a doubt the greatest learning experience on earth for stock traders. There's nothing that compares anywhere. And I highly recommend it.
Yep. And we are actually just 2 months away from that beginning, two plus months away. So I do know a lot of people have asked me some questions about it. And if you do have any questions, just send me an email or give me a call and I'm happy to answer whatever you need to know. But otherwise, those seats are selling regularly and we'll get more information about that as we get closer with details of selling that out.
All right, I'll see you guys later. Mark, feel better?
Yeah,
Thanks.
Mark.
Thanks, everybody. Appreciate it.
We'll talk to you guys later on, okay?
Yeah,
Bye-bye.
the replay will be available in just a few moments. Thanks.